Hello Mindsetters, and welcome to a grade 11 accounting lesson on partnerships, and then specifically on partnership ledger accounts. You will know that in grade 10 the focus of your accounting was on a sole proprietor, in other words a business that is owned by one person. Grade 11 we make it a little bit more challenging and we do accounting for partnerships, in other words a slightly bigger business that has from 2 to 20 partners. Today's lesson, the key focus is going to be on the difference between the current account and the capital account for each partner in a partnership. You'll remember from grade 10 that we only have one capital account for a sole proprietor. But in grade 11 it's a little bit different, because when we're doing accounting for a partnership, each partner has to have two separate accounts, one called a current account and one called a capital account. So what that means is that each partner has got two accounts, and depending on how many partners are in the partnership, you could have 2 or 4 or 8 or really very many different current accounts. And you need to know how to fill them in and what the difference is between the current and the capital account. I'll be explaining that to you just now. Then we need to also realize why we have a separate capital, current and drawings account for each partner in a partnership. Remember, when you have a sole proprietor, there's only one owner and all the profits in that business belong to him or to her. In a partnership, we need to consider that there are more than one partner in the business and each of them needs to get his or her fair share of the profits. So we're going to need to keep separate accounts for each partner. We're also going to learn about the difference between a primary distribution and a secondary distribution of profit in a partnership. What you need to think about is that a partnership earns profits which then have to be divided amongst the different partners, and this is called a distribution of profit. There can be a primary one and a secondary one, and I'll be explaining that to you as well. And then of course we need to know how to complete a whole long set of ledger accounts that are specific and unique to partnerships. So we need to know how to do the capital accounts, the current accounts, the drawings accounts, the salaries accounts. There could be a bonus account, and we need to complete an interest on capital account. So all of these are new accounts that you need to be able to complete as a grade 11 learner. And then finally, we're going to go through the very, very important account. I've highlighted it here and wrote NB next to it. This is called the appropriation account, and this account is used to divide the profits. And that is really probably the most important new one that you're going to learn for partnerships. So make sure that when you're preparing for a test or for an examination, you know how to do this appropriation account. So let's just revise some key concepts about what partnerships are. First of all, you realize that a partnership is a larger business than a sole proprietor. As such, it is different to a sole proprietor in that we have to record the capital and the drawings accounts for the 2 or more partners separately. What this means is that we are going to keep a separate capital account for each partner and a separate drawings account for each partner. And the way you do that is you keep a capital account as per normal, but you put a semicolon behind it, and what you do is you put the name of the partner next to that. So let's say one of the partners is called partner Moyo. What we will do is we will create a capital account for partner Moyo. And let's say that we have another capital account for partner Naidu, then we'll create a second capital account for Naidu with a colon next to it, and we'll write the word Naidu next to it. This is enabling us to keep track of how much capital partner Moyo put in and how much capital partner Naidu put in. This is obviously important because we want to know what each partner's investment in the business is, so that we are able to work out what interest they must get, so that we are able to work out what profits they get, and so on and so forth. It's important for us to keep track of the capital accounts as well as the different drawings accounts whereby they take their share of the profits out of the business. Obviously, if you are in a partnership with another partner, you want to keep track of how much money that partner is taking out of the business. So you need to know what drawings account that partner has so that you know whether he or she has taken his or her fair share of profits. But I'll explain in a few minutes how to do these drawings accounts. So, to go back to the capital account, we need to realize that it records the capital contribution for each partner, and this is often specified in the partnership agreement. If you want to start a partnership with one of your friends and you want to go into business together, very, very importantly, you need to protect yourself with a partnership agreement that specifies a whole lot of different things. This partnership agreement is a contract between the partners that states a number of different things, such as how much capital each partner will invest. It states things such as what salary each partner will receive from working in the business, and it could state other things such as what the profit sharing ratio is between the partners. So this is very important to cover yourself legally, that you create a partnership agreement that details the rights and the responsibilities of the partners, specifies who the partners are, and so on and so forth, so that if ever there's a disagreement or argument in the business, you can go back to that partnership agreement and you have it on a sheet of paper, black on white, to explain what needs to be done, what the different steps in the partnership are, what the different agreements are that you and your partner or partners have made. So usually the partnership agreement specifies how much capital each partner has to contribute to start up the business, and that will be kept in the capital account. Of course, this can change because the partnership might need more money at a later stage. If it needs more money, we could redraft the partnership agreement, or we could specify that each partner is going to increase or decrease his or her capital contribution. If that happens, it is recorded in the capital account. But I'll show you how that works in a few minutes. Then, we now have a brand new account, which is called the current account for the partners. The current account, I'm underlining here in green because this is your new one, which is different to the capital account and which we didn't have in grade 10, because in grade 10 we were dealing only with a sole proprietor. So the current account is also an owner's equity account. So in other words, the current account would go up on the credit side and decrease on the debit side, like most of your, well, like all of your owner's equity accounts do. But what happens is that this account records only the day-to-day transactions between the partners and the partnership. So this is not a long-term account, it is a short-term account that records what happens from day to day. And specifically, the current account includes two new terms that you have to know about: the primary distribution and the secondary distribution. What this is, it's the distribution of profits that accrue to each of the two partners. Those two pieces of information we're going to record in the current account, because this is again for day-to-day or month-to-month transactions, not long-term transactions which are recorded in the capital account. So to explain what I mean by that, when a partner earns a salary, that salary is to be paid into her current account. When a partner earns interest, the interest is paid into the current account. It's almost like the bank account that the partner has with the partnership. In other words, it's money that he or she is allowed to take out of the partnership, and his salary, his interest, his bonuses, various other day-to-day transactions are paid into the current account. Also, what's important is that you'll remember from grade 10 work that the drawings used to be closed off to the capital account. You know, when you did your closing transfers at the end of the financial year, you would close off your drawings amount to the capital account of the relevant partner. Now, in grade 11 it's different, because a partner draws money from the business, or equipment or trading stock or some such asset from the business on a day-to-day basis. So instead of closing it off to the capital account, we are going to close it off to the current account. So the main difference between the two accounts is that the capital account is really recording the starting capital that the partners took in. So this is really, we can say that it is a long-term account. That's the capital account. The current account, on the other hand, is a short-term one, and it keeps track of the day-to-day transactions between the partner and the business. So what goes into the current account? What you need to realize is that we're going to put in something that is called the primary distribution first. Okay? You'll know the words primary from primary school. You went to primary school before you went to high school. The word primary means first. It's the first distribution. In other words, when we've earned the profit for our year, what has to be paid out first? And really what that is the salary, the bonus, and the interest that is due to each partner according to the partnership agreement. In our partnership agreement, we are going to specify each partner is going to earn so much interest on the capital contribution that they've made. Because if a partner wants to start a partnership, she would have to bring money to invest in the partnership. And the partnership must pay her interest for that money, because otherwise she could just as well go and put that money on a fixed deposit in the bank and earn interest in that way. So to compensate the partner for not having the money invested in the bank, the partners will usually agree that they get paid interest on their capital amounts. At the same time, some partners might work in the business as employees. They might be managing their partnership, they might bring special skills to the partnership or do the work for the partnership, so they would need to also get a salary, and if they do really good work, they might get a bonus. So all of these things, the salary, the bonus, and the interest, those three things have to be paid first out of our profits. So whatever profits we earn in the partnership, the very first thing we're going to do is make sure that each and every partner gets his or her salary, his or her interest, his or her bonus. And once that has been sorted out, if there is any money left, we then have what we call a secondary distribution. And that secondary distribution is very, very important, the share of the remaining profits. In other words, the profit that has been left over after, I've put it in bold letters so that you can't mistake it, after the primary distribution has been paid. So what we're going to do, we're going to pay off our primary distribution first, and then whatever profit is left over, that is also going to be shared between the 2 to 20 partners. And that is specified in the profit sharing ratio, which appears in the partnership agreement. So a profit sharing ratio simply tells you what percentage of the profit or what share of the profit each partner gets. So let's say that a partnership has got a profit sharing ratio of 2:1. What that would mean is that the remaining profit is going to be shared with 2 parts going to the one partner and 1 part going to the other partner. They've agreed that, they've made the profit sharing ratio. But some of you might be thinking, surely it's unfair if one partner gets 2 shares of the profit and another partner gets only 1 share of the profit. The reason for that mindset is that one partner may have contributed a whole lot more capital. One partner might have contributed a whole lot more skills. We don't know what the agreement is between the 2 partners, but perhaps we could have a partnership sharing ratio which says that the profits are going to be shared 2:1 to compensate one partner for extra skills, extra business, extra work, extra capital, something along those lines that need to be brought into account when we divide the share of profits. But please remember that it's vitally important to know that we only divide the profits in the partnership sharing ratio, in the profit sharing ratio, after the primary distribution has been paid. So only what's left over after the 2 partners have been given their salaries, interests, and bonuses, only what's left over is going to be divided according to the partnership sharing ratio. So what you need to do, this is the next key point, you need to deduct the primary distribution from the net profit before you start dividing it in the partnership sharing ratio. And we do all of this in the appropriation account. The appropriation account is our special new account, and it is a final account. So I'll just write that there so you remember. It's a final account like the profit and loss account and like the trading account, but it's the third one that we've learnt. In grade 10, you learnt the trading account and the profit and loss account. But those were the only 2 that we needed for a sole proprietor. In grade 11, we're going to use a third appropriation account, which is a final account F3. And this one is the important one that records how the profits are shared between the partners. So the appropriation account is the vitally important one that you have to learn that's new, and we're now going to take a look at how this appropriation account works, and I'm going to show you its skeleton and what needs to go in there. So what I've prepared for you here are some steps that are involved in preparing the partnership ledger accounts at the end of the year. And I'm going to show you how to do that with all of these various steps. So the first thing that you need to do is that you close off the net profit for the year to the appropriation account. You will remember from grade 10 that we have a special T account called the profit and loss account. And this T account is the second final account that we prepare, which we use to work out our net profit. And really what happens is that on this side, we close off all the incomes on the credit side, and on the debit side, we close off all the expenses. If you're not sure what I mean by this, go back to your grade 10 and revise how the profit and loss account is prepared, revise how all the incomes go on the credit side and all the expenses go on the debit side. If I take my incomes and subtract my expenses, I'm going to have some or other balance on my profit and loss account. And in grade 10, what we did is we transferred this to the capital account. Because it belongs to the owner, whatever balance there was on this side was transferred to the capital account as the owner's net profit. In grade 11, we don't have only one capital account for the partners. As I've explained, we have at least 4 accounts, 2 capital accounts, 1 for each partner, and 2 current accounts, 1 for each partner. So what we have to do, we cannot transfer it to the capital account. Instead, we're going to divide it according to our new entry, which is called appropriation. So here's the new thing that's going to happen. We're going to transfer whatever this balance is to a new account called the appropriation account. So this is the difference between grade 10 and grade 11. When you're doing a sole proprietor, the yellow entry would be capital because you take the profit to the capital account. In grade 11, you're doing it for partnerships, and it must first be transferred to the appropriation account before we can divide it according to the profit sharing ratio between the 2 partners. So this is your very first entry. You're going to debit profit and loss, which I've done here, and you're going to credit the appropriation account. So if I've got a skeleton of an appropriation account over here, I've got my ledger accounts here just to illustrate what happens. So let's go to our appropriation. Here it is, F3. The very first thing that we do on the end of the financial year, so let's just pretend it's February 28, because it normally is February 28 is the end of the financial year. The very first thing that we do is we record our profit and loss, whatever this amount is. I'm not going to put amounts in here because I'm just teaching you the basic skeleton, and then we're going to apply it to a real question. So the very first step is to transfer in your general journal your profit and loss for the year. And this number you get, this figure is at the end of the profit and loss account. It's whatever that balance is we transfer here. So it's the contra entry to this entry in profit and loss that I've just made. Normally the questions don't ask you to do the profit and loss account because we do that in grade 10, but in grade 11 the profit and loss account functions in exactly the same way. So just bear in mind one more thing. If there was a loss, the entry would be the other way around. What would happen then is that our incomes on this side in profit and loss would be less than our expenses. So what that would mean is that we would transfer a net loss to our appropriation account, and this entry here for appropriation would shift over to the credit side, and then in our appropriation account it would appear on the debit side. But most of the time we don't have that, because if we're making a massive net loss, I don't think that we should be running a partnership. Okay, so now that we've done that, we've got our profit in our appropriation account, and our next step is to start with the primary distribution. So remember, when we spoke about the primary distribution, we identified that it was 3 different things. It was salaries, bonuses, and it was interest on capital. So the salaries of the partners are recorded in the current accounts of each partner, and then they are closed off to the appropriation account on the debit side. So let's take a look at the salaries account over here. We are going to keep two separate salaries accounts. I've called them salary A and salary B. But what you would do is you would work out what the name of the partner is, and you would give the person a name and write the name over here. But because this is just an activity or a skeleton, we're just going to pretend that the partner's names are A and B so that you can see how it would function. But in reality, when you do an activity, you should put the names of the partners in there. So salary is an expense to the business. And we know that expenses go up on the debit side and down on the credit side. So we would have some balance here for the salary for this partner, and that salary needs to be paid into the partner's current account. So what we write here is current A. The salary belongs to partner A, so what we're going to do is debit it to show that it's an expense to the business, and we're going to kind of pay it into that partner's current account. So I must make a contra entry for both partners. Their salaries get paid, salary A over here, and whatever the amount is that his salary is must be paid into his account. And exactly the same has to happen for the second partner. The salary of partner B also needs to be paid onto the credit side of his or her account, and we have to show the contra entry in salary B. So what we're really showing here is that the salaries of the two partners are simply being paid into the two partners' accounts. So the salary is an expense to the business on the debit side, and it is being paid into that partner's current account on the credit side. That is the first part of the primary distribution. But now if I go back to my instructions, they tell me that the salaries of each partner are closed off to the appropriation account on the debit side. What you need to realize is that the appropriation account records the earnings of the two partners. So these are only the salaries of the two partners that must go into the appropriation account. Any other salaries for employees, for workers, and so on and so forth, as normal, get closed off to profit and loss. But these two are special because they belong to the partners who are also the owners of the business. They must be paid into the appropriation account. So to close them off, what we would do is we would go to each of the two salary accounts. Now you should remember that when we just had an ordinary salary for a worker or an employee in grade 10, what we would do is we would close it off to profit and loss on this side. But what you need to remember is that in grade 11, we are dealing with a partnership. So all of the earnings of the partners are going to get closed off to the special new appropriation account. So instead of putting profit and loss over here, we'll put appropriation in the general journal, and this entry would be recorded in the appropriation account on the debit side. And exactly the same thing would happen with B's salary. So A's salary and B's salary both get closed off to the appropriation account, and if you look at your contra entry in the appropriation account, we would have here salary A, and we would have here salary B. So these two amounts are the salaries that the partners have earned. They are first going to get deducted from the profit and loss before we divide everything in the profit sharing ratio. So make sure you understand how to close off the salaries as part of the primary distribution. Now let's look at our next step. Our next step is that the bonuses of each partner are also recorded in the two current accounts, and they are also closed off to the appropriation account on the debit side. So once again, we do exactly the same thing. We would go to our bonus account if we had one. So in many cases, we don't actually have a bonus account, and in this specific example, we didn't have one. But if we had a bonus account over here, we could have bonus for partner A, and let's pretend that only partner A earns a bonus. I'm sure mindsetters, you know what the entry is. We have to first of all put the bonus, record it in the partner's current account. So we'd have one entry on this side, and then we have to close it off to appropriation. So we'd have an entry on this side that says appropriation. So it should be hopefully clear to you that if we go back to our current accounts, we are going to pay the partner's bonus in here, bonus A, and it would be the general journal and this amount over here. We would then also go to the appropriation account on the next page, and we would make sure that we record the bonus of the partner in the general journal. So in this example that I've just shown you here, only partner A is getting a bonus, so we're only putting partner A's bonus into the appropriation account. Next thing we have to do, according to the steps that I have here, is that we must calculate our interest on capital. And the interest on capital is the interest that has to be paid to each partner based on his or her capital contribution towards the business. So we normally have to calculate that, and these are these calculations that I'm sure you will remember when you had to calculate interest on a loan or interest on a fixed deposit. You had to work out using a percentage and a timeline how much interest each partner is going to get. But when we do the worked example, you will be revising how to do that. But for now, we're just going to show you how to record it. Again, exactly like the salaries and exactly like the bonuses, we record them in the current account of each partner, and then we close them off to the appropriation account. Normally, though, we only keep one interest on capital account, which looks like this. Here we are. And what we do is we'd record the total interest on capital for partner A and for partner B, and we'd pay both of those into the current accounts, record them as expenses on the debit side, and pay them into current A and current B. By the way, all dates here are the end of our financial year, and all journals are the GJ. All of this gets done in the general journal like a normal closing transfer that you'll remember from grade 10. So these two amounts get paid into the two current accounts of the two partners. They're recorded as expenses here on the debit side, and in the current accounts, they're recorded as increasing the amount of money that these two partners have in their current accounts. So this one's going to be called interest on capital, and it's done in the general journal, and it has an entry on the credit side because it's increasing A's current account. There's more money in the business that belongs to A, and exactly the same way we would have interest on capital over here for partner B. And that's again in the general journal and appears on the credit side because it increases the amount that partner B has invested in the business. Usually questions will only have two partners, but you could end up having three partners. If you had three partners, you'd have to keep a separate current account with all of these entries in for every single partner. But that would be quite time consuming, so you're unlikely to get a question like that in an exam, because we're going to be testing the principle that you know what gets paid into which side of the current accounts, and if you can do it for 1 and 2 partners, you can do it for 20 partners. It's just extra effort and extra time. So usually you can expect to get a partnership with only 2 partners. Now, just like the salary was closed off to appropriation for both A and B, the interest on capital also gets closed off to appropriation. So what we do is we just, as normal, close off the account, we add these two amounts together, and we close them off to our appropriation account. These two amounts would be closed off on the credit side, and those would be the total in our appropriation account, which would just be called interest on capital. So over here, I would have interest on capital, and that's also done in the general journal, and that's that total. So if we look back, we can see that the salary has been closed off over on this side, salary for partner B has been closed off, and the interest on capital. All of these 3 nominal accounts, N10, N9, and N8, have now been closed off to appropriation. Just like in a sole proprietor, you close off all expenses and all incomes to the profit and loss account. Mindset is one thing I want to bring to your attention. Please note that there are going to be other incomes and expenses in a partnership. So there could be rates and taxes, salaries and wages, water and electricity, depreciation, all of those other expenses that you had for a sole proprietor can still exist for a partnership. But those ones are not expenses that are paid to the partners. Those are your normal expenses that get closed off to profit and loss. So they would have been closed off to get this balance over here. This profit and loss balance comes from your profit and loss account. So you do it as you normally would do it for a sole proprietor, bearing in mind that the new special expenses that need to be paid to the partners are going to be closed off to the appropriation account. Okay, so once you have that, we've got our profit and loss in the appropriation account, and we've put in these 4 green entries are our primary distribution, our salary, our bonus, and our interest. What now has to happen is we have to look at our next step, which is to calculate the secondary distribution. And this is a very important step, calculating the secondary distribution. Remember we said that the secondary distribution was the share of the remaining profit for each partner. So remember that it's the profit after the primary distribution has been paid. So what we're going to do is we're going to subtract the primary distribution from the net profit in the appropriation account, and step 2, whatever is left must be divided according to the profit sharing ratio, and we have to calculate what each partner is going to receive. So let me explain what I mean by that. We've now got our profit for the year. That's this amount here on the credit side of appropriation. And out of that, we have to pay these 4 things. We have to pay the salaries of both partners, we have to pay the bonus, and we have to pay the interest on capital. What we're going to do afterwards now is we're going to take this figure on the credit side and subtract all of these figures on the other side. So it's like balancing the account out. The total that we have left, we're going to divide in the in the profit sharing ratio and pay into the current accounts of the 2 partners according to the ratio. So these 2 figures here, current A and current B, are calculated by taking the profit for the year, subtracting these 4 green figures, whatever they may be, and then what's left over, we're going to divide in the partnership agreement profit sharing ratio that we've specified, and we're going to give part of it to partner A and part of it to partner B. And what will then happen is we will pay that into their current accounts. So we're going to have for each partner an amount here called appropriation, and this amount is called the secondary distribution. So we can see that the 2 current accounts now keep track of what the partners have earned in the partnership. You can see that these 4 parts at the top, the 3 parts at the top, the salary, the bonus, and the interest, is the primary distribution, and the appropriation account amount is the secondary distribution. So once again, just to revise, the appropriation account amount is the amount that was left over after the primary distribution has been paid. And that is the key point that you have to remember. That's why I've said it so often in today's lesson. Remember the difference between the primary and the secondary distribution, and make sure that you can record them, that you know where each one goes. The final step that we have to follow now when preparing the current accounts is we have now transferred the secondary distribution to the partner's current accounts, as we've done that, and then the appropriation account will balance. But you'll see a practical example when we do an example exam question. You'll see how this actually works in practice. And then the final thing that we do is we close the drawings for each partner. So in other words, how much they've taken out. We close the drawings for each partner off to the current accounts, and we calculate the balance, in other words, the balance brought down or carried down for each account. So the way we do that, if I go back to my example ledger account, the way we do that is we would have here a balance in drawings. the total drawings that the partner withdrew. Sorry, that should be BD. And we would have a balance in the drawings account for the other partner, just like you have a balance in drawings in your sole proprietor. What we do with that balance is we're actually going to transfer it to the current account of each partner. So instead of closing it off to the capital account like you do as a sole proprietor, we close it off in the general journal to the current accounts of each partner. We close it off to the current account of each partner. I've made a mistake at the top there. This should actually be the current account of partner A. And in that way, our drawings account is closed off and our closing transfers are completed. So we would have on this side drawings for partner A and drawings for partner B. So, and these entries are both GJ. So what happens now, you can see that on the credit side of this account, what I've circled in orange is partner A's earnings from the partnership, and on this side it is what she has taken out up to this point, and you then balance this account out to find out how much money she still has in the partnership. And we're going to see that with a practical example. You can see how this would work in practice. So remember, there's going to be a balance brought down or carried down depending on which side is bigger. So that was how to do the various general ledger accounts. And in a few minutes' time, we're going to go through a proper worked example, an example that you can expect in a test or in an exam. But I think before we do that, I think it should be time for a commercial break. So get your thinking caps on, and when you get back after the break, we're going to carry on with a proper worked example. Welcome back, Mindsetters. Before the break, we went through all of the different theory about the partnership ledger accounts for grade 11 accounting. And what we're going to do now is go through an example question to actually apply this knowledge. So let's look at our question. Our question here says, read the information on Black and White Dealers, which is a partnership between J Black and K White. Those are the names of our two partners. And we have to use it to complete all of the different ledger accounts in the books of the partnership. So these are basically all the ledger accounts that are new and unique to partners, capital accounts, current accounts, and so on. And those are the ones that I taught you before the break. So let's now see whether we can do it together using a proper example. It tells us that the financial year ends on the 28th of February 2013, and it says here, be on the lookout for crafty tricks. That's just something that I've added in there. Make sure you know when the examiner is trying to put in a trick that is trying to catch you out, so that you don't fall for it and that you enter all of your transactions correctly. So let's look at our first information point. It tells us at the beginning of the financial year, in other words, the 1st of March 2012, the capital accounts of Black and White had balances of 200,000 and 150,000 Rand, respectively. So what this means is that these are our opening balances. How do we know that? Because it tells us that those were our balances at the beginning of the financial year. And some of you might be asking, okay, we've been given 200,000 and 150,000. How do we know which partner has which opening balance? That's where this important word, respectively, comes in. The word respectively really just means in that order. So in other words, partner Black was mentioned first and 200,000 was mentioned first. So partner Black has got an opening balance of 200,000. Partner White was mentioned second. The 150,000 was mentioned second. So that means that partner White has got a balance of 150,000. So this tells us that these two balances appear in the capital accounts of the partners. So the very first thing we should do is record them in our general ledger in the capital accounts of the two partners. So here we had the capital account for partner Black, and this was on the first day of the financial year, which is the 1st of March, and we put in his capital balance, which was 200,000 Rand. Why am I putting it on the credit side? Well, remember, before the break I told you that the capital account is an owner's equity account, and we know that owner's equity accounts go up on the credit side and down on the debit side. Exactly the same thing needs to be done for partner White. Once again, the opening balance on the 1st of March in his or her account is going to be a balance brought down of 150,000 Rand. So they started the business with a capital contribution of 200,000 for Black and 150,000 for White. So that was our first transaction. Quite easy to start with. Let's look at the next piece of information. Number 2 says, on the 1st of October 2012, Black increased his capital contribution by 100,000 Rand. So the partners agreed that the business needed a bit more money on the 1st of October. So what happened is that Black increased his capital contribution by putting an extra 100,000 Rand into the business. The way we do that is exactly the same as if an ordinary partner puts, if a sole proprietor puts money into the business. We just debit bank and credit capital. Except now we have the special thing that it has to be capital for Black. So to put that into the ledger account, we go to our ledger account, we write October the 1st, it's in Black's general ledger account, and he has increased his contribution by 100,000 Rand, and just like when a sole proprietor increases a contribution, that money is received in the bank, and it would be in the CRJ for the business. So he has increased his capital contribution. Can you see that it is exactly the same transaction as what would happen if it was a sole proprietor increasing her capital contribution? Please, mindset is what's important. Make sure you put it in the right account. If it's partner Black who's increasing the capital account, you put it on the credit side of capital Black. Do not make a careless mistake and put it in White's account instead. And sometimes you will see the exercises in textbooks and exams sometimes have names of partners that are quite similar. For instance, you might have partner King and partner Kong. And then you'd have to be very, very careful to make sure you put it in the right account, because you don't want to lose careless marks for something silly. So what we've done now is we've recorded the additional capital contribution that Black has made on the 1st of October. But now something else happened. It says that White decreased his capital contribution on the 1st of December 2012. So his capital contribution went down. He took money out of the business. But please be very aware that this is not a drawing. A drawing is when the partner withdraws money from his or her current account. This is what we call a capital withdrawal, which means that the partners agree that partner White's investment in the business is going to be less. So it's not going to affect the current account, it's going to affect the capital account only. But now is our first trick that's happened here. It doesn't tell us any amount. We can't see an amount here. We don't know how much White has decreased his contribution by. But here is the clue. It says so that the new capital ratio, in other words, after he's withdrawn that money, on that day was 3:1. So what that means is that partner Black has taken out enough money so that the ratio between partner White has taken out the money. Partner White has taken out enough money so that the ratio between Black and White is 3:1. In other words, Black would have 3 parts of capital and White would have 1 part of capital. So how would we enter that in our ledger account? Well, we know that if partner White is taking some money out of the business, we have to make an entry here on the negative side of his capital account. So what we would do is we would make the entry on December the 1st, and now, because he's taking capital out of the business is paying him money, bank CPJ, and we want to make sure that the amount that he's taking out is enough so that Black has got 3 parts towards his 1 part. So what we have to do is we have to check how much Black's capital is in the business on that day. So this one's an easy one to do in our heads. We can see that 200,000 plus 100,000 is 300,000. So Black's capital on the 1st of December was 300,000. White has to withdraw enough money so that the ratio between black and white is 3:1. So what we need to do, black has got 3 parts, and those 3 parts are 300,000. White has to have some amount on this side so that the ratio is 3:1. In other words, black has got 3 parts and white has got 1 part. I hope you'll be able to see that this 300,000 needs to be divided by 3 to work out what white's capital contribution is, and it needs to be 100,000. Black has 3 parts, 300,000. White has 1 part, 100,000. So how do we reduce white's capital balance so that he has 100,000 left over? Well, that is also not too difficult a calculation. We can do it in our heads. At the beginning, he's got 150,000. He has to have 100,000 at the end. So all he has to do is withdraw 50,000 Rand. So this figure on this side is the 50,000 Rand that White has withdrawn to make sure that now if we balance this account out, we're going to get 100,000 Rand on this side. So 150 minus 50 is 100. So now the ratio is 3 parts black, 1 part white. Now let's look at our next adjustment. Our next transaction, or our next information point, gives us various opening balances. It tells us that there was an opening balance in the current account for black 3,400 Rand, and notice this is debit. White 5,000 Rand, and this is credit. They must tell you in the question whether the current accounts have got positive or negative balances on them. We know that the current accounts are owner's equity accounts, so that means in the T account for the current account, it goes down on the debit side and up on the credit side. So if a partner has got a debit balance like black, it means that he's almost in overdraft. It's like having a negative bank balance. It means that he owes the partnership money. He has taken out more money than what he's able to take out in the business. So he starts with a negative balance on his current account of 3,400, and White starts with a positive balance on his current account of 5,000 Rand. So let's put those two in. We said that black's current account had an opening balance at the beginning of the financial year of 3,400. It's also March the 1st because it's the beginning of the financial year. It's a balance brought down on the debit side of this account. So we can basically say that black owes the business money. He's withdrawn more money than what he had in the business. Similarly, the current account for White, which I seem not to have here, if we had to do the current account for White, let me just draw it in. If we had to do the current account for White, we would start off with a balance on this side, also on the 1st of March, a balance brought down of 5,000 Rand on the credit side, meaning that White has got a positive balance in the business. He has still got money. He can still withdraw that 5,000 Rand as drawings if he needs to do that. Okay, so now we've dealt with the opening balances. Our next item is to look at our primary distribution. Remember, the first thing that has to happen. And we're looking at the partnership agreement, and it makes provision for black to be paid a salary of 90,000 Rand per annum, while White will receive a salary of 8,800 Rand per month. And then there's some more information about it saying, including a 13th check. So this is a second trick which we're going to look at in a moment. But what we need to see is that if the partnership agreement makes provision for black to be paid a salary of 90,000 Rand per annum, you need to know that the words per annum mean per year, but I'm sure you remember that from grade 10 accounting. This salary of 90,000 needs to be recorded in the relevant place. You'll remember from the explanation that we did earlier that the salaries are recorded in several places. We first record them in the salary accounts for the two people. So what would happen is we would put in an amount of 90,000 here, which is an expense to the business for Black, and this gets done at the end of the financial year, which is February the 28th, 2013, and this amount gets paid into Black's current account. Make sure that you write it out in full and gets entered in the GJ. So this 90,000 is going to Black, so I need to make a contra entry in Black's current account, which is over here, and he is going to get on February the 28th, at the end of the financial year, he is going to get his salary recorded on the credit side of his current account in the general journal, and that is going to be 90,000 Rand. We also have to do the same for White in this ledger account that I've had to draw in here, but with White there's a bit of a problem because it hasn't given us the annual salary. What it's done is it's given us a salary of 8,000 Rand per month, including a 13th check. Mindset is a 13th check is something that can be specified in your contract, that usually in December or perhaps in your birthday month you get 2 checks, so you earn 13 salary checks a year instead of 12, and those are part of your salary. They are specified in your contract. So his salary is actually 8,800 Rand per month, but for the year we're going to have to multiply that by 12 months, but there's a 13th check, so we actually have to multiply it by 13. Remember, when we're doing the partnership ledger accounts, we're interested in the end of the year, the total salaries, the total interest for the entire year. So we need to record not 8,800, here's the trick, we actually have to multiply it by 13. So let's get the calculator on the screen. We're going to take the salary of 8,800 Rand, and we're going to multiply it by 13 to work out what his salary for the whole year is, and that comes to 114,400 Rand, and that is the amount that we're going to record in his current account, and that is the amount that we're going to record in salaries. So if I go back here, I'm going to record on the credit side of White's general ledger, salary GJ, and that was 114,000, let's just check that number, 114,400 Rand, 114,400, and this also has a contra entry in White's salary account. So on February the 28th, an amount was paid into the current account of White. Sometimes you have to write small to fit it in the blocks, of 114,400 Rand. And what you should also remember from the lesson before the break was that these two amounts now need to be closed off to the appropriation account, because that is where all our profits and losses are recorded. So again, on February the 28th, we're going to close off these two to the appropriation account. So I'm going to write an entry here for appropriation, and I'm going to write an entry here for appropriation, February 28th appropriation. And we just really rewrite the numbers that we have on the debit side. We write again on the credit side, so 90,000 there, 114,400 over here. And we can now start filling in our appropriation account, which has the contra of these two pink entries here. So if I go to my appropriation account, I'm going to on this side have salary Black, and this is also at the end of the year, February the 28th, salary Black from the GJ. That's the contra entry to this one of 90,000 Rand. Going to fill it in here. And then I have a contra entry to this one, 114,400. That is going to be the salary for partner White. Also in my GJ, 114,400. So you can see that our two salary accounts are now correctly closed off and correctly balanced. You can, if you want to, rewrite the totals underneath here to show that you've balanced the account out, but that's not strictly necessary. Okay, let's look at now, calculate what interest each partner is going to get. So let's first do Black's capital contribution. And what I suggest you do is draw up a timeline starting with the beginning of the financial year and ending with the end of the financial year. And then usually there's going to be a date in the middle of the financial year somewhere where something changes. In other words, the partner puts in extra capital or the partner takes out capital, like we did in information point number 1. So if we look back to information point 1,000 and White had 150,000. We recorded those amounts already. But we're going to look at this amount again, and we're going to see that at the beginning of the year, Black had 200,000 invested in the business. So that's got to earn interest for the year at 8%. Now, if nothing changed, we just multiply this by 8% and work out the interest that Black's supposed to get. But in this example, something did change, and if we look back at information point 2, it says on the 1st of October 2012, Black increased his capital contribution by 100,000 Rand. So he put in more capital, and that more capital needs to earn more interest. So let's go back to the timeline. On this day, he added an extra 100,000 Rand. This day, by the way, was the 1st of October 2012. So he actually had 300,000 Rand invested in the business for this period of time. So he has to be compensated for his extra investment, and he has to get interest on that investment as well. So this is like an ordinary fixed deposit or loan calculation to work out the interest for the year. Shouldn't be too difficult, and you've done it before in grade 10, but let's just do it now to make sure you understand it. We're going to start off calculating the interest for this part of the year. In other words, from the 1st of March all the way to the 1st of October. So we'll count again: March, April, May, June, July, August, September. We don't count October because the change happened on the 1st of October. So this here was a period of 7 months. And then from October to February, there was another amount that was received in interest for 5 months. So let's call this period 1 and this period 2. Let's calculate the interest for period 1. So that's going to be 200,000 Rand, which is the money that he had invested in the business for that period. We're going to multiply it by the interest rate, which in the question was, just refer back to it, question was 8% per annum. So times 8 over 100, and he received that for 7 months times by 7 over 12. So if we do that on the calculator, let's just clear what I've got here. We're going to take our 200,000 Rand, we're going to multiply it by 8% or 8 over 100, and we're going to multiply that by 7 over 12, and the answer comes to, let's just try that again, 200,000 Rand, which is the capital balance that we had, multiplied by 8% or 8 over 100, multiplied by the number of months, which is 7 over 12, and the answer is 9333. I'm just going to round it off to the nearest Rand for now, 9333. So that was the interest that this partner earned for this period of time. For the second period of time, which is the remaining 5 months of the year, he now no longer has 200,000 invested in the business. He now has 300,000 invested in the business because he increased his capital contribution by 100,000 Rand. So this calculation is going to be times by 8 over 100, because that is the interest rate, times by 5 over 12. So the interest that was earned for this period of time was 10,000 Rand. So let me write that in here, 10,000 Rand. So the total interest that he earned for the year is the amount from March to October, which is 7 months, this figure, plus the interest on 300,000 Rand for the remaining 5 months of the year. If you add that together, you get 19,333. In other words, 9,333 plus 10,000. This here is the total interest that partner Black earned for the period. So now we have to record that in the ledger, and the way we do that is we go to our general ledger account and we create a special interest on capital account, which is here, and again on February the 28th we're going to record that the interest on capital for Black, which gets paid into the current account of Black, in the general journal is 19333. Remember, in accounting, we normally just have the ledgers to the nearest rand. If we had to do a contra entry to that, this must obviously be paid to Black in his current account. So in his current account on the previous page, we're going to record, please not the capital account, don't make that mistake. Only increases or decreases in capital get recorded there. The current account is for the day-to-day transactions, and we're going to record here his interest on capital in the general journal was 19333. Okay, we now have to do the same for White. And once again, we have to do an interest calculation. So let's extend the page a bit further and do the details for partner White. So partner White had a similar situation. There's also a timeline starting from the beginning of the year, and our end of the financial year is the 28th of February 2013. And once again, somewhere here, financial year, White's balance was 150,000. So this 150,000 I did when I calculated partner Black's capital or interest on capital. So at the beginning of the year, he had, let's put it here, 150,000 rand. And then during the year, something changed, and you'll remember that he withdrew some money. We remembered that he withdrew some money on the 1st of December, so that the new capital ratio on that day was 3:1. And you can go back and check it, but we figured out that he would draw 50,000 rand to make his capital contribution 100,000 rand on that day. If you're not sure of that, go back to the capital accounts and check how we included that. So partner White withdrew 50,000 on the 1st of December 2012. So after that withdrawal, what actually happened was that his capital contribution was 100 in July, August, September, October, November. That is 9 months, so it's as if it happened up to the 30th of November. So this period of time was 9 months, January and February. So if we look at the calculation is going to be, firstly, we have to take the first period, which is this 150,000 rand. We're going to multiply it by our interest rate, which is the same for both partners. It's 8%. Remember, here it is, 8%. And what we now have to do is we have to multiply it by 9/12, because this was an amount for 9 months. So if we do it on the calculator, we're going to take 150,000 times 8/100, 8/100, times by 9/12. And we get the figure of 9,000 rand for the first period of the year. We're going to do exactly the same thing for the second period of the year, except now instead of it being 150,000, remember on the 1st of December he took out 50,000, so there's only 100,000 left, and that 100,000 is going to be multiplied by 8%, but it's only going to be multiplied by 3/12, because it is for these 3 months from December to the end of February. So once again, if I do this on my calculator, I'm going to take 100,000 times by 8/100 times by 3/12, and the answer that I get for the second part of the year is 2,000 rand. So it's a bit of an easier calculation than what it was for the other partner. So I've got 2,000 rand here for the second period. If you add together this 9,000 plus this 2,000, you get that this partner White, earned 11,000 rand in interest for the year, and we're going to record that in exactly the same way as we recorded it for partner Black. So what that means is we're going to go to our interest on capital account, and we're going to record 11,000 rand, and it's in the general journal, but this is going to be paid into the current account of partner White instead of 11,000 rand. So what we've done now is we've recorded the interest for both partners. One more thing needs to be done with the interest, and that is that we have to go back to the interest on capital account, and this needs to be closed off to appropriation in exactly the same way that the salaries were closed off to appropriation. So what we have to do is we have to make an entry on this side, also on February the 28th, and the entry is going to be appropriation, and that's going to be the total of the 19,333 plus the 11,000. That amount is going to be transferred from here into the appropriation account on the debit side to indicate that we are closing it off as the partner's interest on capital. The way we do that, we're just going to take 19,333 plus my 11,000 gives me an answer of 30,333, and that is the amount that needs to be transferred to the appropriation account, GJ 30,333, and in my appropriation account I've got interest on capital, GJ 30,333. So just think back what we've done here. We've put into the appropriation account our primary distribution, in other words the salary and the interest. There is no bonus in this question, but if there was one, we'd also have it on the debit side of appropriation and do exactly the same thing. And you can show that this account is closed off by putting the total on both sides. The interest on cap and our interest have been closed off to appropriation. So now we need to go to our net profit for the year as per the income statement, and that is given to us as 450,000. Remember, we record the net profit for the year in the appropriation account, so we're going to go back to our appropriation account here, and we're just going to record the 450,000. This is now our profit that needs to be divided, and that will be also on February the 28th, profit and loss, general journal, and that's my 450,000, which is my net profit for the year, out of which I have to pay these primary distributions. So that's now been recorded in the profit and loss account. Now it tells us some other information. It tells us that White's drawings for the year amounted to 122,000. We already know how to record drawings. The way we record drawings is we simply go to the drawings account, which I have over at the top here, and we said that the amount was 122,000 Rand. Here's my drawings. White's capital account, that has been brought down, not brought down, that is done in the general journal, and that's 122,000, and that's going to get put on the debit side of White's account. So out of all this money that he has earned in the partnership on the credit side, he has now withdrawn 122,000 as drawings for the year. And again, I've got to specify that it's White's drawings to check that I'm closing off the correct partner's drawings to the correct partner's account. Okay, so now we're nearly done. We've just got two more pieces of information to look at. It now says profits and losses are shared in the ratio 3:2. 3:2 is the sharing of profits and losses, and it's given me some more information and said White is receiving, we've earned, and these figures here are our primary distribution. But we need to make two special entries here for the current account of Black and the current account of White, where we give them the share of their remaining profits. So what's left after these amounts that I've circled, after those amounts have been paid, what is left must be divided in the profit sharing ratio, and we've been told that the profit sharing ratio is 3:2. So now mindset is this is the key step that you have to follow. To work out what each partner gets, what you need to do is you need to take this 450,000, which is our net profit, and we need to subtract all of these amounts. So we have to subtract Black's salary of 90,000, we have to subtract White's salary of 114,400, and we have to subtract the interest on capital of 30,333. That is going to give me the profit that's left over for distribution, and that is what we're going to share in the ratio 3:2. So the way we have to do that is just work it out on the calculator here. Okay, let's do the calculation. We'll start off with our net profit, which is 450,000. We're going to subtract the primary distribution of 90,000. We're going to subtract the second primary distribution of 114,400, and then the interest of 30,333, and we are left with an amount of, this amount is what is left over for distribution after both their salaries and both their lots of interest have been paid. So this 215,627 is the amount that we have to split between the two partners in the ratio that's specified, 3:2. Now the way we do this mindset is we add these two numbers from the ratio together. 3 plus 2 equals 5. So we have to divide the profit into 5 different shares, and we have to give partner white 2 shares because he gets the smaller share, and we have to give partner black 3 shares. So the way we're going to do the calculation is we're going to take this 215,627, and white is going to get 2 out of 5 shares of the 215,627 because he's getting 2 parts for the 3 parts that black is getting. He's getting the smaller share, and there are 5 shares in total. So always add the 2 sides of the ratio together to find out how many shares you have, and then multiply by the part that each partner gets to work out what their secondary distribution is. So let's work that out. We're going to take the 215,627 and multiply it by 2 over 5 to work out white's share, which means he's going to get 86,106, 8. I'm just going to round it off to the nearest rand, 86,107. 86,107. So that is his secondary distribution. Black, on the other hand, is going to get some more of the profits because he's entitled to 3 shares out of the 5. So what we're going to do is we're going to take 3 out of 5 times by the same figure, 215,627. And if I do that calculation, let's get the calculator back on the screen here. 3 over 5 times by 215,627. The answer comes to 129,376,2. We'll just round it down to 129,376. So that equals 129,376, and that is the part that black's. So the current amount for black was the 129,376, which I'm going to put in here, was the 86,107. So what we've done now is we've taken the share of 450,000 and divided it according to the partnership sharing ratio. We've taken our profits and split it between the partners, and if you add these numbers up, which I'm not going to do now, but you can check yourselves, if you add these numbers up, you should get 450,000 on both sides, which means that our appropriation account is properly closed off. What we still have to do is we have to take these two and make the contra entries in the two accounts. So let's just do that quickly. Remember this figure of 129,376 for black. Go back up to black's current account, and we're going to record the 129,376, I think it was. Just check that figure. It was still in the calculator. 129,376, and that is the amount that's paid to him by appropriation. It's his secondary distribution of profits, which is the GJ. And we have to do exactly the same thing for white. We're going to put an amount here of appropriation, and we can check to see what that figure was. It's also in the GJ. That's the amount that we've calculated for him, and that amount was 86,107. So let's just record that quickly. 86,107. To see what each partner still has in the partnership at the end of the year. So the last thing we now need to do is work out the balance on white's current account. And what we need to do, I'm only going to do it for white's current account. You can do it for black's account. What we have to do is just balance this account out. I'm sure you all know how to do it because it is grade 10 work, balancing an account. You can see that we've got an amount on this side, various amounts, and then the drawings on the other side. Let's just add them up quickly. Adding up the credit side gives me 5,000 plus 114,400 plus 11,000 plus 86,107. So that gives me the balance on the credit side is 216,507. I'll just write here 216,507. And on the other side, we've got drawings of 122,000. Clearly, the credit side is bigger than the single entry here of drawings of 122,000. So I'm going to have a balance brought down. Sorry, a balance carried down on this side. So it's my balance carried down. I don't know what it is yet, but I know that my total on both sides is this 216,507 that I've just calculated. 216,507 repeated here. So to work out the balance that's carried down, what I'm going to do is just take the figure that's in my calculator and subtract, that's the total here, 216,507, and subtract the drawings of partner White, which is 112,000. Sorry, not 112,000, 122,000. Which means that I've got a balance brought down of 94,507. We've got 94,507 over here, and we would just write it on the 1st of March in the new year. We know that White has got a balance brought down of 94,507. This is money that he has in the partnership because it's on the credit side. On the positive side, he can draw that money out if he wants to, and he's got a positive bank balance or a positive balance in the partnership in his current account. I'll leave you to complete the exercise by doing the same thing for Black's current account, but make sure that you understand how to do this. Make sure you understand the difference between the capital accounts and the current accounts. Works for partnerships. We'll see you again next time. Goodbye and good luck. And this is called a distribution of profit. There can be a primary one and a secondary one, and I'll be explaining that to you as well. And then, of course, we need to know how to complete a whole long set of ledger accounts that are specific and unique to partnerships. So we need to know how to do the capital accounts, the current accounts, the drawings accounts, the salaries accounts. There could be a bonus account, and we need to complete an interest on capital account. So all of these are new accounts that you need to be able to complete as a grade 11 learner. And then finally, we're going to go through the very, very important account. I've highlighted it here and wrote NB next to it. This is called the appropriation account, and this account is used to divide the profits. And that is really probably the most important new one that you're going to learn for partnerships. So make sure that when you're preparing for a test or for an examination, you know how to do this appropriation account. So let's just revise some key concepts about what partnerships are. First of all, you realize that a partnership is a larger business than a sole proprietor. As such, it is different to a sole proprietor in that we have to record the capital and the drawings accounts for the two or more partners separately. What this means is that we are going to keep a separate capital account for each partner and a separate drawings account for each partner. And the way you do that is you keep a capital account as per normal, but you put a semicolon behind it, and what you do is you put the name of the partner next to that. So let's say one of the partners is called partner Moy. It's the distribution of profits that accrue to each of the two partners. Those two pieces of information we're going to record in the current account because this is again for day-to-day or month-to-month transactions, not long-term transactions which are recorded in the capital account. So to explain what I mean by that, when a partner earns a salary, that salary is to be paid into her current account. When a partner earns interest, the interest is paid into the current account. It's almost like the bank account that the partner has with the partnership. In other words, it's money that he or she is allowed to take out of the partnership, and his salary, his interest, his bonuses, various other day-to-day transactions are paid into the current account. Also, what's important is that you'll remember from grade 10 work that the drawings used to be closed off to the capital account. You know, when you did your closing transfers at the end of the financial year, you would close off your drawings amount to the capital account of the relevant partner. Now, in grade 11, it's different because a partner draws money from the business or equipment or trading stock or some such asset from the business on a day-to-day basis. So instead of closing it off to the capital account, we are going to close it off to the current account. So the main difference between the two accounts is that the capital account is really recording the starting capital that the partners took in. So this is really, we can say that it is a long-term account. That's the capital account. The current account, on the other hand, is a short-term one, and it keeps track of the day-to-day transactions between the partner and the business. So what goes into the current account? What you need to realize is that we're going to put in something that is called the accounts. You will know that in grade 10, the focus of your accounting was on a sole proprietor, in other words, a business that is owned by one person. Grade 11, we make it a little bit more challenging, and we do accounting for partnerships. In other words, a slightly bigger business that has from 2 to 20 partners. Today's lesson, the key focus is going to be on the difference between the current account and the capital account for each partner in a partnership. You'll remember from grade 10 that we only have one capital account for a sole proprietor. But in grade 11 it's a little bit different, because when we're doing accounting for a partnership, each partner has to have two separate accounts, one called a current account and one called a capital account. So what that means is that each partner has got two accounts, and depending on how many partners are in the partnership, you could have 2 or 4 or 8 or really very many different current accounts. And you need to know how to fill them in and what the difference is between the current and the capital account. I'll be explaining that to you just now. Then we need to also realize why we have a separate capital, current, and drawings account for each partner in a partnership. Remember, when you have a sole proprietor, there's only one owner, and all the profits in that business belong to him or to her. In a partnership, we need to consider that there are more than one partner in the business, and each of them needs to get his or her fair share of the profits. So we're going to need to keep separate accounts for each partner. We're also going to learn a partnership agreement that details the rights and the responsibilities of the partners, specifies who the partners are, and so on and so forth, so that if ever there's a disagreement or argument in the business, you can go back to that partnership agreement and you have it on a sheet of paper, black on white, to explain what needs to be done, what the different steps in the partnership are, what the different agreements are that you and your partner or partners have made. So usually, the partnership agreement specifies how much capital each partner has to contribute to start up the business, and that will be kept in the capital account. Of course, this can change because the partnership might need more money at a later stage. If it needs more money, we could redraft the partnership agreement, or we could specify that each partner is going to increase or decrease his or her capital contribution. This is your new one, which is different to the capital account and which we didn't have in grade 10, because in grade 10 we were dealing only with a sole proprietor. So the current account is also an owner's equity account. So in other words, the current account would go up on the credit side and decrease on the debit side, like most of your, well, like all of your owner's equity accounts do. But what happens is that this account records only the day-to-day transactions between the partners and the partnership. So this is not a long-term account, it is a short-term account that records what happens from day to day. And specifically, the current account includes two new terms that you have to know about: the primary distribution and the secondary distribution. What this is, what we will do is we will create a capital account for partner Moyo. And let's say that we have another capital account for partner Naidu, then we'll create a second capital account for Naidu with a colon next to it, and we'll write the word Naidu next to it. This is enabling us to keep track of how much capital partner Moyo put in and how much capital partner Naidu put in. This is obviously important because we want to know what each partner's investment in the business is, so that we are able to work out what interest they must get, so that we are able to work out what profits they get, and so on and so forth. It's important for us to keep track of the capital accounts as well as the different drawings accounts whereby they take their share of the profits out of the business. Obviously, if you are in a partnership with another partner, you want to keep track of how much money that partner is taking out of the business. So you need to know what drawings account that partner has so that you know whether he or she has taken his or her fair share of profits. But I'll explain in a few minutes how to do these drawings accounts. So to go back to the capital account, we need to realize that it records the capital contribution for each partner, and this is often specified in the partnership agreement. If you want to start a partnership with one of your friends and you want to go into business together, very, very importantly, you need to protect yourself with a partnership agreement that specifies a whole lot of different things. This partnership agreement is a contract between the partners that states a number of different things, such as how much capital each partner will invest. It states things such as what salary each partner will receive from working in the business, and it could state other things such as what the profit sharing ratio is between the partners. So this is very important to cover yourself legally, that you create a